Monday, February 28th, 2022, Maneco 64, home of alternative economics and contrarian views. We're going to look at how a second wave of inflation is coming towards us. And it's not just going to be rising prices or the consequence of inflation. It's going to be more fiscal and monetary stimulus. You might say, well, what do you mean? They're saying that they're going to raise rates at the Fed. We've been told by Bank of America and others the Fed's going to raise rates 7 times. They're going to stop their QE in March. They're going to start selling off their assets off their balance sheet. Well, think again, because the bond markets are saying otherwise now. Yields are starting to fall. And the market doesn't see as much tightening. And I would say very soon the markets will see no tightening at all. The Fed might do a token 25 basis point rate hike in March, but that will be it in my opinion. And last week we saw, of course, members of the ECB, members of the Federal Reserve talking about that already, that both institutions were probably going to pare back on the tightening and keep everything going. And yesterday, I saw a tweet by Jan Neuenhaus. He's at Jan Gold, at Jan Gold. So who is Jan Neuenhaus? Well, he's a Dutch researcher at the Gold Observer, interested in economics, history, philosophy, and psychology. So he tweeted this out. Deputy Prime Minister of the Netherlands, and this is what he said, the Deputy Prime Minister: inflation is the price we have to pay to battle Putin. So there you go. And you might say, well, the Netherlands is a small country. Maybe so, but they all work with the same group of people. They're all working together in all these crises. That's all you need to know. And so, yes, I predict we're going to see more fiscal spending. It's going to be justified because we have a major geopolitical crisis. We're going to see more monetary spending, and the central bankers will definitely be happy to do that. The bankers will be happy with that as well, because they need another coup de whiskey, as I think one of the old central bankers said, is a coup de whiskey. You got to keep the punch bowl full. Because the system is like on its last legs, and I'm not sure how quickly the rising prices will get even worse, because first you get the inflation, the monetary and the fiscal inflation into the system, and we haven't gotten that yet. I know we got it in 2020, but its effects are dwindling. They're waning right now. But I think the effects of it will come out very quickly. And I think it's going to lead to almost hyperinflation, very high inflation. And they'll have Mr. Putin to blame. He'll be the person that caused this. And maybe even the Chinese, because we're hearing here according to the Serious Report, London Paul, who I've interviewed a few times on my channel, he tweeted this morning, Beijing, this is what they said: we oppose illegal sanctions on Russia, and this is his conclusion, so therefore they support their war in Ukraine without directly saying so. So it could get very wild in terms of the inflation. And I'm going to recommend a book now that if you want to understand what's going on, that nothing changes. It's just the actors that change, and the crises that change, but the strategy is always the same. So in the 60s and 70s, we had massive inflation to pay for things like the Vietnam War, to pay for the Great Society experiments, and to pay for pork barrel projects for politicians, right? And they came up with this in the 70s, the energy non-crisis, right? Lindsay Williams, highly recommend that. So who was the enemy in the 70s? Who did we blame for the inflation in the 70s? Well, it was the Arab sheikhs, OPEC, and the greedy OPEC Arab sheikhs who raised the oil price and created the inflation right in the 70s. Well, who's going to be, who are we going to blame this time for the massive inflation? Well, I'm afraid it's going to be Putin and maybe the Chinese. I think they will be as well, if it looks like the Chinese are aligning themselves with Putin. And here again, I'm not taking sides. I'm just observing and trying to help you navigate this, hopefully financially. So who's to say that after a few years of this crisis that we're having with these supposed evil Putin, evil Chinese, CCP, well, we'll probably do a deal with them like we did with OPEC, of course, for the petrodollar, and we'll be friends. So with that, let's quickly look at where the markets are this morning. One thing I would say, though, if you want to protect yourself, what I've been doing for the last, well, more than a decade is try to stack as much physical gold and silver. Yes, physical. The paper version is no good unless you're just trading ETFs and futures, GLD, SLV, only financing the bankers. Of course, the bankers are in charge of all of this, and they don't have your best interest at heart. They're gonna, the bankers and the politicians, of course, they want to inflate the system out of all proportions, right? And you're going to pay for it by holding their fiat currency. You're going to be financing them by holding extra fiat in the bank, because that's how it keeps the system going. You put $100 or £100, they'll lend 1,000 on the back of that. And again, the money, your money that you put in the bank becomes an unsecured loan to them. And as we've seen recently, they can freeze that anytime they want. So yeah, have a little bit of insurance outside the system. I think that's my opinion. It's not advice, of course. And if you do want that, look below in the description of my video. I have a few ways of acquiring gold and silver. One is physical. The other one is through Glint. And I recommend as well that you do your search, you shop around for the best deal. But I would say gold investments, they will match any price out there in the UK, of course. So it's 20 to 9 a.m. London time. I was up yesterday at 11 when the futures markets opened in the US. At 6 p.m. Eastern time. It was very volatile. I think the Dow opened down about 500. Gold shot up to 1933 right off the bat. Silver went up to almost 25. And then, of course, the management started. The paper management on COMEX started. But I'm not concerned. They're going to run out of rope. You know, there's only enough physical out there for them to keep playing this game. If they could always keep gold and silver suppressed, the price would still be at $35 per ounce, and it isn't, of course. So right now, spot gold is up $11 at 1900. So we're right at 1900. High's been 1933, as I said, and the low has been 18.89. Spot silver is down about 4 cents at 24.21. The low's been 24.07, and the high was on the open last night at 24.88. Well, the Dow future is down 525 or 1.5% at 33,520. The low's been 33,370. So it's been down, as much as 650 overnight. Has rebounded a bit. The S&P future is down 85, just under 2%. The NASDAQ 100 future is down 250 points or 1.75%. The FTSE is down 122 at 73.65, 1.6%. The German DAX is down 2.3%. So let's look at the currencies. And I'm going to start today with the ruble. Let's see where the ruble is, because I see that the Russian central bank has raised interest rates. So it says here, the FT is reporting, the central bank boosted its main interest rate to 20% from 9.5% in an emergency decision to offset the risk of the ruble's rapid depreciation to financial stability and protect Russians' savings from being wiped out, according to RIA Novosti, the state-owned news agency. They're trying to keep people from taking their money out of the bank, so they raise rates. It's a normal reaction. So let's see where the ruble is. Well, the dollar is up 31% versus the ruble, so that's how the ruble is doing. We're trading above 105 now. I think recently it was trading around 75. So with $1 now, you can buy almost 110 rubles. And I think last week it got up to 90. So yes, the ruble is getting hit. It's going to be tough on the Russian people, of course, because what this means is that they're going to have to pay more for everything because their currency goes down. But I think in the long term, Russia has very good fiscal situation. Their debt to GDP ratio is 17%. Their external debt is like 35%. And they have a lot of gold. They have a lot of reserves. Of course, a lot of these fiat reserves have been kind of frozen, but I think they'll be okay. Russians have gone through worse crises than this one. And I spoke about that last night in my live stream. Am I defending the Russians? Am I anti-Ukrainian? No, I'm just talking about what I think will happen. I think they'll be fine. They'll come out probably stronger. And unfortunately, the West, we have a lot of debt. We're going to come out weaker, and we're going to pay for it with inflation as well, just like the Russian people. The pound or sterling is down 0.5%, 133.50. The euro is down almost 1%, 111.64. The dollar's unchanged versus the yen, 115.60. Dollar is unchanged versus the yuan at 631.16. To the other currencies here, Aussie dollar is down just over 0.5%, 71.88. The dollar is up 0.2% versus the Canadian dollar, 127.86. And the Kiwi dollar is down 2/3 as well at 67. General commodities, well, crude oil has had an interesting trading session overnight. WTI crude got as high as 98.41. Right now we're at 94.77, up about 4%. I think we were up about 6.5% last night. Brent crude got up to 101.22. Right now we're at 97.80, up 3.75%. Copper is up 0.2%, 4.51, and U.S. nat gas is up 3.38% at 462. And to finish off, as I said earlier, bond markets now are kind of paring back their expectations of tightening from the central banks. The 2-year yield here this morning is at, 1.5. It's down 9 basis points. And the 10-year is down 7.3 basis points at 191. So the other thing that I think is happening is that pretty soon the yield curve could also point to a recession, and it's going to make it very difficult for the central banks to tighten again, and that means more and more inflation. And I'll finish by saying, in the fiat currency system, which we've had since August 15th, 1971, you need to keep the debt going, and whenever you issue debt, there's never enough money out there, because the debt is the money to pay off the debt, because there's usually interest to pay. And when you issue the debt, you don't issue the interest either. So the end game is quite near, I would say. Is it a matter of days, weeks, months? I don't know. It could be a few more years or a few weeks. I don't have a crystal ball, but I think what will really trigger the inflation or loss of confidence even in the currency will be a psychological change by the public. They will realize that prices will never stop rising, and they're going to try to get rid of their currency as quickly as possible. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.